One of the biggest mistakes I see people make is house hunting before they have been financially qualified to buy a house. I'm Chase Hansen, your DFW Realtor, and today we're talking about the financial side of buying a house. Most home buyers have to get a loan, a mortgage, to pay for the house, but most people going into that process don't actually know the details of what lenders are considering to say, yes, you qualify for a mortgage, or no, you're not ready yet. Now, I'm a big believer in making sure my clients are as informed as possible so they can be as prepared as possible so they can get the best deal possible. So, my goal in this video is to pull back the curtain and show you how people get qualified for a loan. And that way you can put your best foot forward as you step in to the home buying process. So, let's talk about it. These are the 4 things that are needed to qualify for a mortgage. This is what a lender looks at to pre-qualify you, and these are the limits they use to say how much you can borrow when you're getting a mortgage. That's why I always say you should build out your team of professionals before you start house hunting. Have your lender help you set a budget. Have an agent to represent you in the contract negotiations. These things don't just help you save money, but they can keep you from getting taken advantage of by the sellers or from making mistakes that disqualify you from getting a house at all. So here it is, the 4 factors to qualify for a mortgage. The first one they'll check is your credit score. Your credit matters when buying a house because you're taking out what may be the largest loan of your life. The minimum for many lenders is usually a 620 credit score, but this is a situation where the higher your score is, the better off you are. Having better credit not only makes sure you qualify in the first place, but a higher score can mean lower fees for some lenders and even land you with lower monthly payments in some cases. Better credit can lead to less costs because it's less risk for the lender to write that mortgage. So if you've been putting off working on your credit, maybe start taking steps in that direction. The second thing on our list is proof of income. To get a mortgage, you have to be able to show that you have consistent income to be able to pay your monthly payments. Now, a common way that lenders approach this is called the 28% rule. That means that when they make your loan, no more than 28% of your gross monthly income should be going to your mortgage. So it's not just enough that you make more money than your mortgage, but they want to have a safe gap to know that your mortgage fits in with the rest of your life. That's why you shouldn't just guess how much house you can afford. Another factor that goes into this is your job stability. Now, lenders typically want to see that you've been working in the same field for at least 2 years. Now, again, writing a loan is an investment for them. So these qualification factors are about protecting that loan and making sure it's not too risky for them to do that. So you'll probably have to provide pay stubs, employment records, and sometimes tax records to your lender during the approval process. The third thing that they'll look at is your monthly debt burden. Now, usually this is referred to as your debt to income ratio, or DTI. Now, again, lenders don't just want to know that you make more than your monthly payment. They want to know that the monthly payment can fit affordably into your life. So for many banks, they have a 36% rule for DTI. So that means that including your mortgage, your total debt monthly payments shouldn't exceed 36% of your monthly income. So that debt to income ratio includes car payments, credit card payments, student loans. And so if you have ways to lower your monthly payments in other arenas, that can actually open you up to afford more house. And you should know that when you're getting a mortgage, you don't want to buy new cars or take out other loans or load up credit card debt because that can actually ruin your ability to afford a house. Fourth and finally on the list is cash on hand. Yes, a lender is going to want to see your bank account. They want to know that you'll have enough money available to close on the house. That means you want to save your down payment plus closing costs. Now, my typical recommendation for people is saving your down payment plus 3%. And down payments will depend on the loan you're getting and options available to you. Like, yes, the gold standard is 20%, but you might be able to get a loan with 3% down, or 5%, or 10% down. Some of that depends on your credit and impacts other fees, but there's options available. Also, you can get a gift from a family member. That's very normal. Just know that you'll have to tell your lender that's what you're doing because they will want to document where any money is coming from for the purchase of the house. So to review, the 4 factors that lenders look for when qualifying someone for a house are credit, income, debt, and cash. Now, those are the financial puzzle pieces you want to have in place when you're ready to buy a house. If you need a recommendation for a good lender in the DFW area or North Texas, I'd be happy to introduce you to some of the people that I trust and enjoy working with. And if you're thinking about buying a house or moving in the DFW, I'd love to be the realtor on your team to help you search, negotiate, and navigate the whole process from start to finish. You can get in touch with me through my email in the description, or there's also a link to schedule a free consultation where we can talk through your home needs. No obligation with that meeting, just help and advice from a professional who's familiar with the home buying and selling process. You can also find me on Instagram at Hansen Realtors DFW. Again, my name is Chase Hansen, a realtor serving the Dallas-Fort Worth Metroplex in North Texas. Be sure to like this video, subscribe to my channel, share this with a friend who would find it helpful. Thanks for watching. I'll see you next time.